economy, not just a couple of variables. These variables are given as guideposts, but they certainly does not mean that we're just looking at a couple of things, because the economy is a big place and there are many things going on. And finally, I think that these thresholds, while many have said, well, the committee doesn't have to do anything once these thresholds are crossed, I think they're going to be viewed as triggers, or they're certainly going to be viewed as triggers, at least in the sense that the committee will take a different view of the stance of monetary policy once these thresholds are crossed. So I think they may be viewed as triggers for action. We have to be ready to treat them that way. So that's it for triggers and thresholds for monetary policy. So let's turn to the other part of what's going on in monetary policy, the balance sheet part of the policy. This is the bond buying and the mortgage-backed securities buying that the Fed has been doing on and off during the last several years. So the committee adopted the so-called QE3 at the September 2012 meeting. This policy was also done in a more state contingent way, done in a way that depends more on economic conditions than we have in the past. We did an open-ended program where we didn't have a fixed end date. No end date was specified. And the program was extended at the December meeting, and this is kind of a detail, but we had this Operation Twist. We were selling shorter-term securities and buying longer-term. Now we just quit selling the shorter-term, print new money, and buy the longer-term securities. So it's a more aggressive easing. I think the outright purchases is more aggressive easing than the so-called Operation Twist. So the current approach, after the dust settled here at the end of the year, is to purchase $40 billion in MBS and $45 billion in Treasury securities per month. If you add that up, that's more than $1 trillion at an annual pace. More than $1 trillion. I mean, I'm in the business, and even I think that's a big number. So, so this is a pretty aggressive easing program here. And there is no specific end date, but the notion is that we don't want to specify end dates for asset purchase programs because the end dates tended, in QE1 and QE2, tended to occur at sort of inconvenient times from the perspective of the data that was coming in on the U.S. economy. So the committee was, in those circumstances, was ending up pulling back accommodation right at the time when things were starting to look sour for the U.S. economy. This is the problem with not reacting to economic events and trying to react only to the calendar. So the examples are in March of 2010 when the European sovereign debt crisis was heating up, QE1 was ending and the Fed was sort of going on hold. And again in July 2011, Fed was going on hold because we had a fixed end date for that QE2 program, and the debt ceiling debate was occurring, and we got a big downturn actually in the U.S. economy during that time frame. So with QE3, the committee does not have a fixed end date, but instead seeks substantial progress in labor markets before pausing purchases. This is a flexible program. You could do a lot of things here. You could taper the program. You could slow down the pace of purchases. You could do a lot of things. And I think the committee has left the door open this time and tried not to be in a box where you say, well, I'm going to buy a certain amount, for a certain period of time, and then I'm going to for sure end the program at that time. So hopefully we'll be able to draw the program to a close at an appropriate time given the behavior of the U.S. economy. So I just wanted to illustrate with this picture here the end of QE1 and the end of QE2 and how they kind of occurred at inopportune moments. This picture goes from January of 2010 up to the present. This is the St. Louis Fed's Financial Stress Index. This takes a lot of measures of financial stress, including the VIX index and credit spreads and other daily data on the U.S. economy. It aggregates them into one index. So if this thing is at 0, that would sort of be the average level of stress in the U.S., financial stress in the U.S. economy over the over the post-war period. When this thing goes up, that means stress levels are increasing. In the QE1 ended in April of 2010. Right around that time, the European sovereign debt crisis heated up. People got very nervous in U.S. financial markets, so this was sort of an inopportune moment to be ending that program. Again, in July of 2011, when QE2 ended, this was exactly late July and early August was exactly the period when the arguments about the debt ceiling in the U.S. were heating up, and European sovereign debt crisis again heating up during that period, financial stress rising over that period. So that's an example. This chart is just an example. I'm not saying it's causal here. It didn't cause the financial stress, but it was an inopportune moment to be ending the program because those were just exactly junctures where other things were going on in the world that were making things look more risky here in the U.S. So now, on the guidance on the balance sheet policy, the committee has maintained a qualitative approach to the balance sheet policy. So you could say, well, gosh, you just told me how cool thresholds are. Why don't you put thresholds also on the balance sheet policy? And I guess my answer to that is it's just a bridge too far. We just did that for the rate policy. I don't think we could probably get to agreement on the balance sheet policy as well, and maybe it's not prudent to do it that way for the balance sheet policy. I will say this, the clear intention, I think, is to end the balance sheet expansion sometime before you would be raising the policy rate. So sometime before you get to 6.5% unemployment, and under the assumption that inflation stays below 2.5%. So the FOMC is just going to have to make a judgment concerning this program as macroeconomic data arrive. And I think private sector expectations concerning the QE3 program will also have to adjust appropriately as data arrive. If you're as optimistic as I am about 2013 and 2014, you might envision an earlier end to this program. But if you're more pessimistic, and many forecasters are more pessimistic than I am, you might envision it going on for longer into 2014. Now, given everything I've said, you might ask, is monetary policy more accommodative today? And I think that it is quite a bit more accommodative today than it was, say, 6 months ago. So why is this the case? Well, first of all, you've got the QE3 was adopted in September. So that's sort of the big one, and that's the one that people would talk about the most. But there are three other aspects to monetary policy which have been changed and that I've emphasized here. The QE3 program was taken on as this open-ended program with a pretty rapid rate of asset accumulation. So I think it's going to be more effective than what we had in place during 2012 and earlier in some of the earlier programs. The TWIST program was replaced with these outright purchases. So I think that the TWIST program is you're saying I'm selling a 3-year and I'm buying the 6-year. I mean, how much difference does that really make? Whereas this program is just saying, forget about selling anything. I'm just going to create new reserves and purchase the assets. So I think that that's probably going to have a bigger impact on expectations and a bigger impact on the economy than the TWIST program did. And finally, the policy rate guidance was revised, which helps alleviate this pessimism problem, which I think was a counterproductive aspect of our policy previously. So for all these reasons, I think what you've got after the various adjustments that occurred during the fall, you've got a pretty much an easier policy here than what you had 6 months ago. I don't think financial markets have really appreciated that, the extent of this move. Okay, so that brings me to the U.S. macroeconomic outlook. And as I was saying earlier, I've argued that the potential growth rate for the U.S. economy is somewhat lower than it has been in the recent past. If you look at other countries that suffered through large financial crises like we did, you'll see that they tended to grow more slowly after the crisis. I think that's absolutely what's going on in the U.S. So that's a lower number than we're probably used to, the 2.3% there. And then my forecast is that real GDP growth will, however, be faster than that 2.3%, at about a little over 3% in 2013 and 2014. Now, some forecasters would have that more tilted to 2014 and pull back on the 2013, but we've got it about evenly distributed between the 2 years. And what are the main factors behind this? I think I've just made the case that monetary policy is easier than people appreciate. I also think there are reduced headwinds in the U.S. economy, and I'll talk a little bit about that. and some reduced uncertainty in the U.S. economy. It's not that uncertainty has gone away completely. It certainly is not, but it's not quite as pervasive as it was, let's say, a year ago. One big one would be the U.S. election was resolved, so one way or the other, we did get the election over with, so the uncertainty part of that is gone, and you know what the new elected configuration is. I've got unemployment falling, I've got a picture of that, and I've got inflation remaining near target. So here's real GDP growth. The red bars are the St. Louis Fed forecasts, the blue bars are history. We don't quite have all the data for 2012, so that one's still at a forecast. It's going to come in a little lower than 2%, and then we've got this going up to over 3% in 2013 and 2014. Now, if you look at a picture like this, where we've had bad growth numbers for 4 years in a row, then 3% looks gigantic. But 3% is actually not a gigantic number for the U.S. economy. We have certainly had that in the past. A lot of people have been questioning why aren't we getting 4 or 5 or 6% in the U.S. economy. So I don't think 3% is out of line, even though it looks big on this scale. It's not unreasonable to have that kind of expectation for the U.S. economy. Then on inflation, I think the FOMC will be able to keep inflation and inflation expectations appropriately close to target, and so that we'll actually do well on both on inflation numbers by the time the numbers come in for 2013 and 2014. So we'll be right about at our 2% target. And unemployment, I think, will continue to tick down. And I'm more of an optimist on this than others. But if you look at this picture, this goes back to 2009, which was the highest year for unemployment. It has ticked down every year, 2010, 2011, 2012, and those were not great growth years. Those were not great growth years for the U.S. economy, but unemployment nevertheless ticked down during this period. So I think this trend will continue in 2013 and 2014. Making this kind of prediction has served me very well over the last couple of years, and I think I'm going to stick with it. So, you know, unless the U.S. goes back into recession, I would expect the unemployment rate to continue to tick down. Now, one of the main issues here is whether more people will start re-entering the labor force once the economy starts to improve and the labor markets start to improve. So I don't think we're at a low enough level for the unemployment rate to have people saying, oh gosh, the labor market looks so great, I'm going to come in off the sidelines and re-enter the labor market. I don't think we're in that kind of situation. We were in that kind of situation in the 1990s, but the unemployment rate was a lot lower in the 1990s. The national rate actually hit 3.8% in 2000. So in that kind of an environment, then you really did get people that were sort of on the fence deciding to come back into the labor force. But we're not in that situation yet. So for now, I think what will happen is that those that have left the labor force will stay out. The unemployment rate will continue to tick down in 2013 and 2014. Let me talk a little bit about reduced headwinds. I think one that's key, and I know there are realtor groups here, is that the housing market has improved during 2012. I expect this to continue in 2013. The anecdotal evidence that I've heard from Wisconsin here, but also from the 8th Federal Reserve District, my district, is definite improvement on prices, sales, housing starts. It's pretty clear across the country that the housing market has improved. It's not racing back to the bubble level, and I don't expect that to occur, but it is improving, and I expect that improvement to continue in 2013. I also think that some aspects of the U.S. fiscal situation have been addressed with the recent deal in Washington. I think come hell or high water, we're going to have to see some kind of a deal in the next 2 months on the debt ceiling. I don't know what that's going to look like. There will be brinksmanship on that, but we will get some kind of deal, and we'll be able to proceed from there. I also think growth in emerging markets will likely improve in 2013 relative to 2012, so I see that as a bullish factor for U.S. growth and for U.S. multinationals in particular. And the sovereign debt crisis, and I'm going to talk a lot about the sovereign debt crisis as I end the talk here, has recently been less disruptive in global markets than what it was in 2011 and 2012. The key event in the world has been the European sovereign debt crisis over the last 2 years, even 3 years, going back to 2010. And it was a boomerang effect from the financial crisis, global financial crisis. It led to this debt crisis in Europe. Europe has at times seemed to be careening out of control and has really upset global financial markets, and that's been the key. You saw that in my earlier graph, but that's been the key development globally in the last couple of years. One thing you should keep in mind about Europe, if you add Europe together, the European economy is a little bit bigger than the U.S. economy, so it's gigantic. And to have an economy of that size in as much trouble as they are is very disruptive to the global economy, and that affects us. So the fact that Europe has recently been somewhat less disruptive, I think, is a bullish factor for U.S. growth. And also, I do not think that Euro area growth will deteriorate the way it did in 2012, and I have a graph here about that. So this is Euro area growth going from 2009 to 2014. The blue bars are history. The red dots are the ECB. These are not my forecasts. These are the European Central Bank forecasts. The lower line is the low of their forecast. The higher line is the high. This is Euro area growth rates. So the key thing about this picture, I think, is that if you look at 2011, where growth was maybe about 1.5% in Europe, this is real growth now. Then in 2012, they went negative, so double dip recession in Europe. That's how severe the European sovereign debt crisis was. Of course, that's uneven across Europe. The peripheral countries having a lot more trouble than some of the core countries, but even the core countries having trouble. I just don't see a drop of that magnitude going from 2012 to 2013. I would say it's not that things are going to improve that much in Europe, but this forecast seems to suggest, the ECB forecast seems to suggest maybe slightly negative growth in 2013. But it's not the drop-off that it was between 2011 and 2012. So it's kind of, things are going to not be good in Europe, but probably not be getting a lot worse in Europe, and probably, maybe zero growth for 2013 is what the ECB might be saying based on this picture, and then improvement in 2014. So I think that bodes well probably for the U.S. because you don't have further deterioration in Europe. It's not that you see a lot of improvement, but you don't see further deterioration. Again, the key issue, I think, is what is going to happen with the European sovereign debt crisis. And let me just talk about what's been going on because a lot has been going on. It's been important. The announcement of the ECB's outright monetary transactions program has been more successful than it might have been anticipated. These outright monetary transactions are phantom. They have not actually occurred. So this is one of the miracles of modern macroeconomics. The ECB has so far not been required to purchase any sovereign debt of any nation up to now. But the deal is that they've said, okay, we'll purchase in a somewhat unspecified way sovereign debt of key nations if those nations apply through European channels for aid. So far no nation has applied for aid, so they haven't had to purchase anything. But this has provided a backstop to European debt markets and kept yields lower than they would have otherwise been. A very good question is, how is this program going to proceed during 2013? Are the countries, Spain being the leader, but others as well, are countries going to have to apply for aid? If they are, then the ECB will have to actually intervene in those markets, and then it will be unclear at that point how that intervention will proceed and whether it will be successful or not. But up to now, that has not been the case. Governments in Spain in particular have been reluctant to apply for this program, so they've stayed on the sidelines. So you've kind of got this stalemate situation in Europe where, which has been widely reported, where they're not applying for the program. The ECB says, well, since they're not applying, we're not buying. and you proceed from there. And this has been successful. Here's the picture from January of 2012 up to the present. This is Euro 10-year bond spreads relative to Germany. And you can see the various countries here, if you can't see it, Portugal, Ireland, Italy, Spain, Greece. And they have the green line and the vertical line in the middle is this speech that Mario Draghi gave in London in late July, in which he said the ECB would intervene in force if necessary to contain the situation, and that was followed up by more announcements from the ECB after that. Since then, these bond spreads have come in considerably for all of these countries, so this has been a successful announcement, but it's a precarious situation because it's not clear how this program is going to proceed going forward, so we'll see. Here's the 5-year sovereign CDS spreads. This is how much you have to pay to buy protection against a default on European sovereign debt for various countries. Again, this is Portugal, Ireland, Italy, and Spain. After these did run pretty high in the first part of 2012, after the announcement in July, they tended to come in and be lower. And so this has inspired some confidence in global financial markets. So I guess my conclusion is that Europe is going to be a wild card. That's on my concluding slide here. So let me give you the overall summary of what I said and just remind you, and then we'll take some questions if you have any. So first of all, I think U.S. monetary policy looks more accommodative today than it did 6 months ago. And it goes beyond just the fact that the Fed announced a QE3 program. It's also these other aspects of policy which I think have had the effect of maybe tuning the policy in a more accommodative direction. So more accommodative monetary policy might combine with reduced headwinds, reduced uncertainty in the U.S. to produce better growth during 2013. I will admit that if you had listened to me in 2011 or 2012, you would have got a similar picture, and that would have proven overly optimistic for both of those years. However, I still think it's the right way to view the current situation. It's the right way to view the data that we have on the U.S. economy, and it's the right way to think about the situation. So I think improved growth is a good way to think about 2013. We all understand that things can happen. We all understand that things can go wrong, and that might, there's risk every day, and that's something we have to cope with. But if you want an overall view of 2013 right now, I think this is the right one. And then the wild card continues to be the European economy. It's not growing, it's shrinking, might shrink even a little bit more or have no growth in 2013. Could again erupt into a bad situation, so I think we have to keep an eye on the European situation. But for now, the so-called OMT program has been successful over the last 6 months. So I'm going to stop there and let you guys ask questions. I really appreciate the opportunity to address this audience. It's a great group, and so thank you very much.
Okay, so again, raise your hands if you want somebody with the mics to come your way. And while you got somebody there? Okay.
At what point does the debt ceiling, we're at 16 plus trillion, it goes to 20 trillion in certain forecasts, when does that become an issue for us? At what dollar amount or percent of GDP? Is a debt ceiling something we should sit here and have concern
I think it became an issue for us long ago. So I think we're past the point where debt's an issue for the U.S. The European countries have shown that there is such a thing as borrowing too much. You borrow too much and you lose confidence in international markets, then you're going to have a full-blown crisis on your hands, and it takes years to get out of that. So I don't think you want to play with that fire, and there's no sense in playing with it anyway. Just decide how much you want to spend and what you want the taxes to be and go that way. There's no sense in building up huge debt loads, I don't think. And it's not just, I think borrowing too much in international markets used to be thought of as a problem that you saw in emerging markets, the less developed parts of the world. the fact is that this has come on to European shores and major countries like Spain and Italy. These are not small players in the global economy. So there is such a thing as borrowing too much. You don't want to get into that situation.
Jay, has somebody over here?
James, you talked a little bit about less uncertainty going forward. Other than the elections, could you elaborate on that a little bit?
Yeah, I think I think there was a lot of uncertainty about the fate of the U.S. housing market. I think that's kind of dissipated. I think we were just saying the elections have, I think markets don't like uncertainty, so you resolve the uncertainty. It might not get resolved in the way markets wanted it to get resolved, but it still gets resolved, and then people can place their bets going forward, having more idea about where the policy is going to be and where the economy is going to be. Also, I don't see a lot of, I see reduced uncertainty possibly about Europe, and I see reduced uncertainty about the emerging markets. I think emerging markets slowed down in 2012, but it'll probably pick up some in 2013. China is probably I didn't talk a lot about China, but China is one of the bigger players there. So for those reasons, I think some of the question marks have gone away. Only some. There's still a lot of question marks, but there are less question marks maybe than there were.
Other questions?
Further to your comments on China and Europe, and maybe to move you a little bit further out on the limb, what do you think about the value of the dollar versus the euro and versus the renminbi, based on what you're seeing, what we're doing and what they're doing?
Well, the traditional response of Fed guys is we don't comment on the dollar. The dollar's the Treasury's policy. And while we do look at the dollar as an input to monetary policy to try to get a read on what the international situation is like, we don't undertake monetary policy specifically with the dollar in mind. We try to think about the U.S. economy, U.S. inflation, and go from there. I'll say this. I'm a little disturbed that Japan seems to be taking a more explicit exchange rate policy, and there has been more sentiment in global financial markets that have suggested that everyone's going to try to weaken their currency as a way to get growth in that particular part of the world. So that's a so-called beggar thy neighbor policy, and it's not going to lead to good outcomes if we go down that road. So I hope we're not heading in that direction.
Okay, one last question here. Go ahead.
With the change in the strategy on when you would unravel the current accommodative policy, you've changed one uncertainty and just replaced it with another one. Have you talked at all about when unemployment, if it met your forecast, for example, would imply that monetary policy would start to get more strict within 2 years instead of 3 years?
Yeah, I think that's very much part of the debate, and how to unravel this complicated policy that we've put together is very much on my mind, and I'm certainly with the hawkish camp on the committee on that. I think we are taking risk. I will say this to people in the room here, I've come from the monetarist tradition. I've worried a lot about inflation and that we're taking inflation risk. The truth is it hasn't materialized so far, and inflation for 2012 is actually a little bit below our target. So I think I remain cognizant and worried that we're creating an inflation problem for ourselves out there in the future, but we haven't gotten there yet, and it hasn't been a problem so far. And so I think the way to proceed is to continue to be aggressive in our monetary policy and be cognizant that we could have an inflation problem in the future, and we'll be ready to move and contain that if we need to.
Okay, thank you, Doc.
All right, thanks a lot.
Really appreciate it. Okay, thank you very much, Dr. Bullard. And before we end the program, just want to give some final thank yous to everybody who made this possible. It's a big event, and a lot of people worked hard to make it happen. So